For 10 years, platinum was the dead money of the commodity world. While gold hit all-time highs and silver squeezed, platinum sat dormant. But look at the chart today. Platinum just crossed $2,455 an ounce. The retail investor thinks, I missed it. It doubled from the lows. The smart money looks at gold trading at $4,500 and thinks, platinum is still on a 50% discount. For most of the 20th century, platinum was more expensive than gold. It was the rich man's gold. It traded at a 50% premium to gold. If that historical relationship restores with gold at $4,500, platinum shouldn't be $2,055. It should be $600-700. We aren't looking at a top. We are looking at a mean reversion from the most undervalued state in history. The king of metals is waking up. To understand why this rally is sustainable, you have to look at where platinum comes from. It is the most concentrated supply chain on Earth. 75% of the world's primary platinum comes from one country, South Africa. Another 10 to 15% comes from Russia, so 90% of the supply is in BRICS nations. But the problem in South Africa isn't just politics, it's physics. The national power grid, Eskom, has collapsed. They have rolling blackouts, load shedding, for 12 hours a day. You cannot run a deep-level mine without consistent electricity. You can't run the elevators. You can't run the ventilation. You can't run the smelters. South African miners are shutting down shafts not because they want to, but because they have no power. Supply is falling off a cliff exactly as demand is exploding. This is the textbook definition of a supply squeeze. While supply is dying, a new source of demand is being born, the hydrogen economy. We talked about silver for solar, episode 12. Platinum is the silver of hydrogen. To make green hydrogen, you need an electrolyzer. The catalyst inside? Platinum. To turn that hydrogen back into electricity, fuel cells for trucks, ships, you need platinum. The global push for net zero relies on hydrogen for heavy industry. Projections show that the hydrogen economy alone could consume 20 to 30% of the total platinum supply by 2030. This is a market that was already in deficit before hydrogen showed up. Now you have a new, price-inelastic buyer entering a broken market. The auto industry needs it for catalytic converters, the jewelry industry needs it, and now the energy industry needs it. There isn't enough metal to go around. There is another hidden driver: substitution. For years, car makers used palladium for catalytic converters because it was cheaper. Then palladium skyrocketed to $3,000, while platinum sat at $900. So the engineers retooled the factories. They switched back to platinum. That switch is happening right now. We are seeing massive industrial buying as automakers dump palladium and hoard platinum. But here's the catch. You can switch from palladium to platinum. You cannot switch away from platinum in a hydrogen fuel cell. It is chemically unique. So as the world transitions from gas cars palladium to hydrogen hybrid cars platinum, the demand curve shifts permanently to platinum. The smart money is long platinum and short palladium, the pair trade. Let's talk about valuation. At $2,455, platinum feels high, but priced in gold, it is at a historic low. If you believe that gold is the true money, episode 03, then platinum is the cheapest asset on the board. Historically, 1 ounce of platinum bought 1.5 ounces of gold. Today, 1 ounce of platinum buys only 0.5 ounces of gold. To return to the mean, platinum would need to triple against gold. If gold stays at $4,500, platinum goes to $6,750. If gold goes to $6,000 Bank of America target, platinum goes to $9,000. This is why billionaires are buying it. It offers the safety of a precious metal with the explosive upside of a tech stock. It is an asymmetric bet. Limited downside, it costs $100 just to mine it. Massive upside, reversion to the mean. Just like silver, episode 014, platinum has a paper problem. The futures market is much larger than the physical market. However, the platinum market is tiny. It is much smaller than silver. All the platinum ever mined would fit in your living room. This makes it extremely susceptible to a corner. If a single large entity, like a sovereign wealth fund or a tech giant, decided to secure their supply, they could drain the London vaults in a month. We are already seeing lease rates for platinum spike. This means there is a shortage of physical metal available for delivery. When the lease rates spike, the price explosion usually follows. The paper shorts are getting squeezed. How do you play this? You have two choices, the metal or the miners. The metal, physical platinum coins, Eagles Maples, or the Sprott Physical Platinum and Palladium Trust, SPPP. Just like silver, avoid the paper ETFs if you want safety. The miners, this is tricky. Remember, 75% of production is in South Africa. Investing in South African miners like Sibanye-Stillwater or Impala is a high-risk leverage play. You are betting that they can keep the lights on. They pay massive dividends, but the jurisdictional risk is extreme. The smart money prefers the rare North American platinum miners, like Sibanye's U.S. operations or smaller explorers in Canada. They trade at a premium because they have electricity and rule of law. In a world of chaos, the safe jurisdiction wins. Let's summarize the investigation. Platinum at $2,450 is just the beginning of a structural re-rating. The smart money playbook: 1. Treat platinum as a long-term value hold. It is the cheapest hard asset relative to gold. 2. Watch the platinum to gold ratio. We are aiming for 1-1 parity, $4,500 platinum. That is the first target. 3. Be careful with South African miners. They are cheap for a reason. Position size accordingly. 4. Physical possession. Platinum is dense and high value. You can store $100,000 in your pocket. It is the ultimate portable wealth. The industrial world needs it. The monetary world forgot it. That is the definition of opportunity. This is the smart money wisdoms. The future belongs to the owners. Thanks for watching. Like and subscribe. See you next time.